You're looking at a company that owns over $42 billion in commercial real estate. It operates in 119 countries. It generates more rental income than most dedicated property firms on Earth. You probably know it as the place that gave you food poisoning at 2 a.m. in an airport. Yeah, McDonald's, the burger chain. Except, and I want you to really sit with this, it is not a burger chain. It never really was. In 2024 alone, McDonald's pulled in over $7.3 billion from a single line item in its books. Not from Big Macs, not from McNuggets, not from those disturbingly consistent fries. From rent. Charged to the very people who think they're running their own McDonald's restaurants. Ronald McDonald is your landlord. Let's start with a name you've almost certainly never heard. Harry J. Sonneborn. Not Ray Kroc. Not the McDonald brothers. Harry Sonneborn, a former VP of Finance at Tasty Freeze, a mid-century ice cream chain basically nobody remembers. He showed up to McDonald's in 1956 looking for a job, and in roughly 10 years, he built one of the most brilliant financial schemes in the history of American capitalism. Here's the context you need. In the mid-1950s, Ray Kroc was struggling. He had a great concept, a fast, efficient, replicable hamburger restaurant. But the franchise model wasn't printing money the way he'd hoped. His royalty take was tiny. Franchisees could ignore him. And crucially, he had no leverage. Sonneborn walked in and said, "Stop trying to extract money from the food. Start extracting it from the ground." We are not technically in the food business. We are in the real estate business. The only reason we sell 15-cent hamburgers is because they are the greatest producer of revenue from which our tenants can pay us our rent. Harry J. Sonneborn, McDonald's first president and CEO. Think about the elegance of that. Sonneborn's insight was that the hamburger was just a rent collection mechanism. The burger exists to make the franchisee money so that the franchisee can pay McDonald's its cut. The food is the engine. The real estate is the vault. So in 1956, Kroc and Sonneborn launched McDonald's Franchise Realty Corp., a secret subsidiary that most customers never knew existed. It went out and leased land, then subleased it to franchisees at a 20% markup, then a 40% markup. Franchisees were responsible for insurance and taxes. McDonald's just collected the spread. And here's the truly diabolical part. If a franchisee refused to follow McDonald's rules, they weren't just breaking a business agreement. They were breaking their lease. McDonald's could evict them. The real estate wasn't just a revenue stream. It was a leash. 1956, Franchise Realty Corp. Founded. 40%. Markup charged to franchisees on lease costs. 68. New locations added in a single year after the model launched. After McDonald's adopted the Sonneborn model in 1958, the chain added 68 locations in a single year. That growth trajectory never really stopped. So what happened to Sonneborn? The man who literally invented the financial architecture that made McDonald's a trillion-dollar adjacent empire. He fell out with Kroc in 1967 over an argument about expansion pace. He sold his stock for $3 million, walked out the door and never ate at a McDonald's again for the rest of his life. Had he held that stock, it would have been worth over $1 billion by the time he died in 1992. He refused to ever discuss the company again. You almost have to respect that kind of principled financial self-destruction. But if Sonneborn was the architect, what exactly did he build? Because the structure McDonald's operates today is more sophisticated and more ruthless than even he designed. The numbers are genuinely staggering. Let me show you what McDonald's actually looks like when you strip away the red and yellow and the cartoon clown. As of 2024, 43,477 restaurants across 119 countries. About 95% of them are franchised, meaning someone else runs them, someone else hires the staff, someone else deals with the E. coli scares. McDonald's, meanwhile, owns the land and buildings at roughly 45% of those locations outright, and holds long-term master leases on most of the rest, which it then subleases to franchisees. The math of this is obscene. McDonald's owns the building about 80% of the time. It owns the land about 45% of the time. Where it doesn't own outright, it holds a long master lease from an outside landlord, marks it up, and passes it to the franchisee. McDonald's is essentially the middleman landlord between the actual land and the people cooking your fries. And it's taking a cut on both ends. Think about that. McDonald's borrowed money to buy land, then used the franchisee's rent to pay back the mortgage, then kept the land. It's like if your landlord made you pay off their mortgage and charged you a fee for the privilege, which actually is just being a landlord. But at 40,000 locations simultaneously. In 2024, franchised restaurants generated approximately $15 billion in revenue for McDonald's Corporation, compared to about $10 billion from the stores McDonald's actually runs itself. But here's the kicker. The company-operated stores have an operating margin of roughly 12 to 18%. The franchise segment, almost purely rent and royalties, runs at an operating margin north of 82%. 82%. Margins that make Silicon Valley software companies look at their shoes and shuffle awkwardly. McDonald's achieves those margins by doing essentially nothing. The franchisee runs the restaurant. McDonald's just deposits the check. The genius of the original Sonneborn model, and this is the part that aged like fine wine, was structuring it so that McDonald's costs are fixed, long-term mortgages at historical rates, while franchisee payments are variable and inflation-indexed. As prices rose over the decades, franchise payments rose with them. McDonald's mortgage costs stayed flat. The spread between those two numbers has been compounding for 70 years. $42 billion. Estimated real estate portfolio value. $15 billion franchise revenue in 2024. 82% operating margin on franchise revenue. 46% target overall operating margin? 2025. For context, McDonald's real estate assets represent roughly 99% of the company's total assets on its balance sheet. When you buy McDonald's stock, you are not, in any meaningful sense, betting on the quality of their beef. You are betting on the trajectory of global commercial real estate prices in high-traffic zones across 119 countries. You are buying a REIT that sells fries as a side hustle. But all of this looks clean and brilliant from 30,000 feet. What does it actually look like from inside a franchise? Because the people who write those rent checks every month have some very different feelings about this arrangement. If you want to open a McDonald's franchise in America today, here's roughly what you're signing up for. You'll pay an initial franchise fee of around $45,000. You'll need somewhere between $1.3 million and $2.3 million in total investment, equipment, decor, working capital. You do not get to own the building or the land. McDonald's owns that. You get a 20-year operating agreement. Then you'll pay a royalty of 4 or 5% on all gross sales, an advertising contribution of another 4%. And then there's the rent. McDonald's charges franchisees rent based on a percentage of gross sales, currently around 8 to 15% in the US, depending on the location. It's whichever is higher, the fixed base rent or the percentage of sales. On a good month, you pay more. On a bad month, you still hit the floor minimum. Do the full math. A franchisee running a typical U.S. McDonald's location, doing $3 million annually, could be paying 5% royalty, $150K, 4% advertising, $120K, and up to 15% rent, $450K. That's $720,000, roughly a quarter of revenue, flowing back to McDonald's before the franchisee pays a single worker or flips a single burger. Here's my favorite part. After 20 years of paying that rent, 20 years, 2 decades of writing those checks, the franchisee owns absolutely nothing of the real estate. 0 equity. The land appreciated, probably significantly. McDonald's captured all of it. The franchisee did the labor. McDonald's kept the asset. This is, architecturally, how aristocracies worked. And it's not a theoretical problem. In 2018, franchisees were so fed up that they formed the National Owners Association, the first independent franchisee group in McDonald's entire history. At the second meeting in Dallas, an estimated 1,300 franchisees showed up, representing 3/4 of McDonald's entire domestic operator base. They described themselves as being on a destructive path. One internal newsletter told owners they were gathering to share with the board of directors why we believe we are on a destructive path. By 2023, those same franchisees were threatening to flood the Federal Trade Commission with complaints. They'd hired a heavyweight attorney. They described feeling held hostage. And they used a word that genuinely alarmed McDonald's corporate. Fear. Fear of retaliation. Fear of losing their franchise renewal. Fear of speaking their minds at company meetings. When your tenants are afraid of you, you've stopped being a franchisor. You're just a landlord. During the COVID crisis, the dynamic got even starker. Sales dropped 25–30%. Franchisees begged for rent abatements. McDonald's offered deferrals, a pause on payment, not forgiveness. One franchisee wrote in a survey, "Deferrals only kick the can down the road.
When the balloon comes due, 25–35% of operators will go bankrupt. Another wrote, other companies are doing far more for their franchisees than McDonald's. We get useless rent deferrals. Others get rent abatements. McDonald's, to be fair, has one of the strongest balance sheets in the restaurant industry. The argument from corporate is always, the system works, the locations are prime, the brand is worth something. And structurally, they're not wrong. But that argument is a lot easier to make when you're the one collecting rent rather than paying it.
But this isn't just a story about franchisee tensions. McDonald's real estate strategy has a quality that most people miss entirely. It's recession-proof. Not because the burgers sell in a downturn. Because the rent gets collected, no matter what.
Here's a question worth sitting with. In 2008, when Lehman Brothers collapsed and the financial system went into full cardiac arrest, what did McDonald's do? It went shopping. While property markets cratered, while developers went bankrupt, while land was selling at distressed prices, McDonald's Franchise Realty Corp. was out there capitalizing on an anemic property market, buying up more land and buildings at the exact locations where it already operated. It was the financial equivalent of buying up your neighbor's house during their divorce and then renting it back to them. This is the structural genius that Sonneborn baked into the model in 1956 and that nobody has ever really dismantled. McDonald's revenue is not primarily driven by food sales. It's driven by rent. And rent, with a major global brand as your guaranteed tenant, is remarkably stable, even when consumer spending craters. People may stop going out to dinner. They don't stop paying rent.
Let's slow down. McDonald's real estate has been described by analysts as economic insulation. Here's a more visceral framing. If a McDonald's franchise struggles and closes, McDonald's hasn't lost a business. It's just found itself with a vacant commercial property on a high-traffic corner that it now gets to re-let to the next operator at whatever the current market rate is. Downside risk is almost entirely absorbed by the franchisee. McDonald's just moves on to the next tenant. This is why, during the 2008 recession, McDonald's outperformed the S&P 500. While banks were imploding, McDonald's was collecting rent from 30,000 plus locations and quietly expanding its land bank at bargain prices. The model doesn't just survive crises. It can exploit them. And the site selection process is no accident. McDonald's uses traffic analysis, pedestrian flow data, census demographics, and urban development projections to choose locations. The company reportedly has a minimum threshold of 20,000 vehicles per day for new sites. It is not picking spots randomly. It is methodically acquiring the highest traffic, most desirable commercial plots in the world, then using franchisees to develop them, then holding the underlying asset forever. The company now manages those assets through multiple real estate subsidiaries, a layer of corporate structure that keeps the property business at a comfortable arm's length from the fast food conversation. McDonald's will happily talk to you about the McFlurry. It is somewhat less forthcoming about its commercial property management operations.
Consider the Moscow deal, just briefly.
When McDonald's entered Russia in the dying days of the Cold War, January 31st, 1990, they negotiated a lease on that first Moscow location for 1 ruble per square meter per year. The lease ran for 49 years. Russia was so desperate for the symbolism of Western capitalism walking through its doors that it gave McDonald's essentially free commercial real estate in central Moscow for half a century. When McDonald's eventually exited Russia in 2022 due to the invasion of Ukraine, that real estate portfolio was part of a $1.4 billion charge-off. But for 3 decades, they were collecting rent on land they'd acquired for the price of a postage stamp. That's not fast food strategy. That's geopolitical real estate arbitrage.
All of this raises one uncomfortable final question. If McDonald's is essentially a property company, a REIT with a fryer attached, what does that mean for the future? And who, exactly, is getting the worst end of this deal? Let's zoom out to where this matters beyond McDonald's itself. Because the McDonald's model didn't just build one company. It became a template. Burger King, Yum Brands, KFC, Taco Bell, Pizza Hut, Subway. Virtually every major fast food chain operates some version of the Sonneborn playbook. Own or control the real estate. Franchise the operations. Collect rent. Let someone else deal with the labor disputes, the food safety inspections, the minimum wage fights. The next time there's a news story about fast food workers striking for better wages, pay attention to who's actually their employer on paper. In most cases, it's the franchisee, a small business owner who is himself being squeezed by a corporate landlord above. The corporation can respond to labor pressure by saying, "We don't set wages, our franchisees do." The franchisee can say, "We can't afford higher wages, our margins are already crushed by rent." And meanwhile, $42 billion in commercial real estate sits on a balance sheet in Chicago, appreciating quietly. There's also the question of what McDonald's represents in terms of urban and suburban land use. The company's site selection criteria, minimum 20,000 cars a day, high foot traffic, strategic corner lots, means McDonald's has spent 70 years systematically cornering the most commercially valuable real estate on the planet. Every prime intersection in suburban America that has a McDonald's on it is an intersection where McDonald's decided the land was worth owning. There have been serious investor proposals, multiple times over the decades, to spin McDonald's real estate off into a separate REIT. Analysts have argued the property portfolio, valued independently, would be worth far more than McDonald's current market cap suggests. Management has always resisted. Because the combination of owning the land and controlling who operates on it is precisely where the power lives. Separate the REIT from the brand, and you lose the leverage over franchisees. The whole thing only works because McDonald's is simultaneously your landlord, your brand licensor, your supply chain, and your regulator. In 2024, McDonald's opened 2,116 new restaurants globally, the fastest expansion pace in years. Its capital expenditure rose 18%, primarily directed at new restaurant development. And almost all of those new openings follow the same pattern. McDonald's acquires or leases the land, builds or oversees the building, then hands it to a franchisee to operate, while retaining the real estate.
At the same time, some of those franchisees were writing angry letters to the FTC. Others were forming coalitions. The National Owners Association, now a fixture, continues to push back on rent structures and operation mandates. McDonald's continues to post 46% operating margins.
The tension here is fundamental and probably irresolvable. McDonald's has built a machine that is genuinely excellent at generating wealth for its shareholders, and genuinely excellent at generating anxiety for its operators. Both things can be true simultaneously. The machine doesn't care about the contradiction. What Harry Sonneborn understood in 1956, and what McDonald's has perfected across 70 years, is that the real prize was never the royalty on the hamburger. It was the land underneath it. And the beautiful, terrible insight is that you can sell someone the right to operate a business on that land. Let them build it, let them staff it, let them worry about it, and simply collect the appreciation and the rent in perpetuity. The Golden Arches aren't just a logo. They're a beacon. For customers, sure, but mostly they're marking a property that McDonald's owns and intends to own forever. So, McDonald's, the fifth largest commercial landlord on Earth, a $42 billion property empire that sells you a Big Mac to justify the existence of the rent invoice. Is this genius? Unquestionably. The Sonneborn model is one of the most elegant financial structures ever designed for a consumer business. Fixed costs, variable income. Inflation protection built in. Recession-proof. Geographically diversified. Crisis-resistant. The spreadsheet basically runs itself. Is it ethical? That's where it gets complicated. Because there's a version of this story where McDonald's is the perfect franchise partner, giving ordinary people access to prime real estate, a global brand, and a proven system they couldn't build themselves. And there's another version, where McDonald's is a company that takes your life savings, makes you work the hard part, and keeps the asset. Both versions are supported by the evidence. What I keep coming back to is Harry Sonneborn, the man who designed all of this, was pushed out for his trouble, sold his billion-dollar stake for $3 million, never ate at a McDonald's again, and died on a 630-acre estate he bought with the proceeds. That's a man who understood the game perfectly, and still somehow lost it. Maybe the real lesson is this. The people who design the system rarely end up benefiting from it, as much as the system itself does. McDonald's doesn't need Sonneborn anymore. It doesn't need Kroc. It doesn't need any particular franchisee. The machine just runs, collecting rent. 43,000 locations, 119 countries. The only question left is, who's next to sign the lease?
Look, I'm just one person making these videos from scratch. No team, no studio. Just research, a script, and a burning need to expose how these systems actually work. If this video made you see McDonald's differently, or made you question any company you interact with every day, that's exactly why I make these. Hit like. It literally tells me this is worth continuing. And subscribe, because the next company we're going after, it makes McDonald's look like a lemonade stand. I'll see you there.